Just like investors in the stock market, there are two kinds of leaders, bulls and bears. What would you call Xi Jinping? If you asked him, he'd probably say he's a bull, someone who can drive the Chinese economy to newer heights. But his limitations stand exposed. There is panic in Beijing. Investors are fleeing China. They're dumping Chinese stocks. The loss so far is $7 trillion in less than 3 years. $7 trillion in less than 3 years. Last week, there was a sell-off. That alone led to a loss of almost $2 trillion in value. The problem is too big to ignore, and President Xi Jinping has finally decided to step in. He called a meeting with Chinese regulators to find a way to improve global sentiment about China and its worsening economy. The meeting was supposed to take place today. So far, we've not heard about the outcome. No big announcements yet. Earlier today, the news of this impending meeting lifted Chinese markets. But it has not impressed major investors. They seem to have run out of patience and they're moving their money to India. We're talking about billions of dollars in investment in Indian stocks. Wall Street banks are placing bigger bets. There is a gold rush, and this shift is hard to miss. Investors prefer India over China increasingly because India has consistently proven to be the driver of growth, with China developing a serious perception problem. Now, it is no longer seen as an investor-friendly destination, not just for foreign investors, but also for the local ones. They are unhappy, and many of them are venting on Weibo. Weibo, as you would know, is one of China's biggest social media platforms. It's like their Twitter or X. So here's what Chinese users are doing. They look for the account of the US Embassy in Beijing, and they start posting comments to it. These comments are basically criticism. They're slamming China's economic policies. But why do it on the US Embassy page? It's a way to escape Chinese censors, a trick that these people have devised. You see, when you post on social media, censors pick it up. But when you comment on someone else's post, there's a lesser chance of discovery, or so they think. It's a relatively safer space to criticize China, which is why they go to the US Embassy account on Weibo. It's being flooded by comments. On one particular post, there were over 100,000 comments. Let me show you some of them. This is what they're saying. Could you spare us some missiles to bomb away the Shanghai Stock Exchange? The Weibo account of the US Embassy in China has become the wailing wall of Chinese retail equity investors. These are comments by Chinese users. And do you know where they were posted? Below the picture of a giraffe. The original post was about wildlife conservation, but the comment section is filled with criticism of the Chinese economy. Well played, we say. These comments are also revealing. They show that a large number of Chinese citizens are unhappy with the meltdown in their markets. For 6 straight months now, investors have been selling Chinese stocks in large numbers. Last month alone, global funds sold Chinese stocks worth $2 billion. And they've not seen the worst yet. Experts say China's equity market is yet to hit the bottom. I have an assessment from Nomura. That's Japan's largest investment bank. They think China's economic dip, and I'm quoting, is ongoing and is likely to worsen. And what is the basis of this assessment? China's weakening economy, it faces multiple challenges, from a failing property sector to a contracting manufacturing sector. Last month, factory output declined for the 4th straight month. Manufacturing is clearly slowing down, and I'm not the one saying this. China's official data for a change shows the real picture. This sector is shrinking. And when you join all of these dots, it's easy to see why China is being called uninvestable. So investors are looking for alternatives, and they're narrowing down on India. 2 Wall Street banks have endorsed India, the Goldman Sachs Group and Morgan Stanley. They have a projection for the next decade. They say India is the prime investment destination. Goldman Sachs expects robust inflows into the Indian markets. Morgan Stanley believes, and I'm quoting, India will become the 3rd largest economy by 2027 after the US and China. And numbers support their assessment. Last year, the Indian stock market received some $20 billion from foreign investors. The momentum is clearly on India's side. Experts say Indian stocks are now overpriced. They're among the most expensive in the world. Look at the top Indian companies. Their shares are 27% more expensive when compared with the average prices from 2010 to 2020. So one can expect a price correction too. But the larger picture looks like this. More people are buying into India's growth story. The world is betting on India's rise, and the overall trajectory remains positive. What about China? Well, they have their task cut out. Short-term measures and assurances will not be enough anymore. They'll need concerted action to win back investors and reverse their decline. And the onus is squarely on Xi Jinping.
From impeachments to inaugurations, if it's a political story, we are on the scene. The race for the White House is heating up.
We're beating Biden.
How dare he say that?
If it's breaking news, we're live with the latest coverage. From the White House, the State Department, and Capitol Hill, we know the issues, but above all, we know the players to bring you the latest in-depth analysis on all the key stories that we're covering. I'm Eric Ham. Join me from Washington here on Firstpost America.